Hey, hey, hey. What's going on, everybody? Happy Monday, February 17th. Time for a one-on-one like we've never had before. So glad to have everybody with us. We are going to have a panel today to talk about all these exciting things that we're all communicating about in the water cooler, in the lunchrooms, and especially on LinkedIn and many threads. The idea came about when I did a post on the CFPB and the fact that I felt like, you know what, the mortgage business doesn't need a nanny anymore. And got a lot of feedback. Some people vehemently disagreed, some people agreed. And so what I've done is taken a bunch of issues that I know are very important to all of us. We'll see if we can cover them today. Among them, the CFPB's current state, LO comp, the new administration and tariffs, artificial intelligence, LO of the future, minority lending, financial literacy, tech bloat, high rates, and credit vendors. And so I brought on four really distinguished guests. You know them, I'm sure, but I'm going to introduce them anyway. Melissa Landale is recently founded Praxis Lending Solutions. Previously was the president of the Mortgage Collaborative in the business, as far as I can tell, since 2002. Hi, Melissa.
Hi, I'm super excited to be here.
I know. I'm super stoked to have you here. Mark Hamilton is the CEO of Metric Mortgage Corporation. Started out as a loan officer at Metro Cities in 2003. What's up, Mark?
Hi, Greg. How's it going?
Going great. He jumps in my posts all the time. He actually sort of disagreed with me, which is okay. Alfred Pitzner, Managing Director of Conforma Compliance Group, formerly the SVP Chief Compliance and Legal Officer at James B. Nutter, where he has been active, still active, even as they wind down since 2006. And then my dear friend, Latasha Wadi, Executive Vice President, Legal Officer at NFM Lending, sits on multiple boards and is an author of a children's book around empowering kids to build healthy money habits through captivating stories. And let's be honest, what could be more important than that? I think we'd all agree that that's something very important.
Absolutely.
Hi, everybody.
Hello.
Hi, Greg.
I've never done this before. This is a panel.
We'll be gentle.
And so, I brought on chief legal counsel, somebody with a compliance background, a business owner, somebody that ran one of the most prominent associations in the Mortgage Collaborative. Like, we've got a lot of opinions in here. So let's jump in. Let's start talking about the CFPB, because I made a post saying that we don't need a nanny anymore, and that a tamped down CFPB would be okay, that there's enough governing bodies among what's left so that will be okay, and that barriers of entry are such that we've got a better breed of mortgage people anyway. And Alfred took exception with that, which is all good. So what are your feelings on it?
I don't think that you're completely off base, but I think the analogy I used maybe on your post was, you have a speed limit posted, doesn't mean anyone's going to be minding their speed limit. If there's not a cop around the bend somewhere, people are still going to speed. And I don't think that the Bureau, has the collection of regulatory agencies outside the Bureau, frankly, are not really there to do what the Bureau does. And if you look up enforcement actions by the OCC, and try and see what they've done practically nothing for the last several years. It's only been the Bureau that was active in that space. HUD's not an enforcement agency. They're there to protect the MMI fund. The same thing is true of FDIC. They're there to make sure banks are stable, that they're secure. So we don't really have a lot of folks out there that do what the Bureau does. And the fear that I have is that when you take away the Bureau, or you minimize its importance, you have state actors that step into that space. And that's really where the cost is for IMBs. It's not the Bureau. The Bureau is certainly inconvenient, and we don't always like what the Bureau does, but the state actors are where we spend our money when it comes to enforcement and compliance. It's not at the Bureau level.
Latasha?
I think that first, good afternoon, everyone. Thanks for having me on here, Greg.
Of course.
And as an IMB, I do think that there needs to be some level of federal decision making, because if we think about the last administration and the states feeling like they needed to step into the gap, there is several multitudes of interpretation when it comes to states trying to enforce federal law. And so if we have a regulator that is giving guidance and they're kind of leading the charge and what the expectations are, it makes it a little bit easier to navigate. I'll preface that with saying that I do think in past administrations, the CFPB has been very aggressive. They haven't given much direction in terms of regulatory changes. They've done it by enforcement action, which also, makes it very difficult for IMBs to navigate. And so I'd like to have some iteration of a CFPB or a federal regulator. I just want them to be a little bit more collaborative with who they're regulating and how they enforce their laws.
Mark, what do you think? You're a business owner. You own a mortgage company. What are your thoughts? Are you going to be sleeping? You're going to be sleeping better at night now?
Well, we're going to make, in the short run, we'll make more money, but it sort of feels like it's kind of a late cycle. 2010 through 2021, we did a lot of Fannie, Freddie, FHA, a lot of really good full doc conventional business. But lately, with the prices being really high in our market in California and interest rates being high, we're seeing a lot of interest only, a lot of non-QM. And so I don't think it's the time to be pulling back regulation. As much as I'm going to benefit from it, it's not going to have a good ending.
All right, Melissa, bring up the caboose on this one. You know just about every leader in the IMB space and then some. So what you get? First of all, how do you feel about it? And are you getting any sense from the people that you collaborate with?
I agree with what everybody here has said thus far. I think there's a good thing about like the balance that the CFPB brings to our industry. I think, Latasha, your point about the risk of having states kind of step in and take on that more that higher level kind of enforcement or regulatory oversight on mortgage lenders would cause more harm, than I think would be helpful for us. So I'm hopeful that Scott McKernan and his appointment will help us to get a little bit more balance and a little bit more. Director Chopra was very much, as Latasha said, a very much, a reactionary, like they regulated by enforcement. Like you knew when something was bad, when you had, an enforcement action against your organization. Here, I feel like Scott's going to take a much more collaborative approach to things and hopefully help us to move the CFPB into a space that we can count on, I guess, to a different degree in the future.
Yeah, and then part B of that question, have you heard from any industry leaders on how they're feeling about the activities around the CFPB?
I think everybody's just a little nervous. I think, Scott's appointment is helpful. And so I think there is some positivity around that, but he still has to be confirmed, right? So but I think there is a little bit of positivity around it, but I think people are still nervous around, how this is all going to play out.
I'd like thoughts from each of you. We can start with you, Mark, on RESPA reform, the idea of RESPA reform, and also LO comp.
Oh, well, no, it doesn't seem like anyone really follows the rules for LO comp, right? I mean, in the broker space, people will set up different levels of compensation at different companies, and at the bank level, they're pushing pricing exceptions, as if it's an everyday occurrence. And so it seems like we have this regulation around LO comp that is distributed differently through the different channels, right? Direct lending follows one path, brokers do another, and banks just do whatever they want to do. So it would be great if we just agreed to one set of rules and then all of us followed it, then it would set a level playing field.
And any opinion on RESPA? Been around 50 years.
Right. I think we've gotten used to RESPA. I don't think that I think that that's a rule that we're all playing, fairly.
Yeah, that's fair. Al, I've made the argument that if there is RESPA reform and things are laxed a little bit more and you're able to give gifts of appreciation based on how you feel, how much you love the person giving them to you or how much they've given you, that it could make it really, really difficult for the smaller players to keep up with the deep pockets. What are your thoughts on RESPA reform, and do you have an opinion on LO comp?
I agree with you, and I also agree with Mark to the extent that this has been a part of our industry for so long that we kind of know how to navigate that. I think MBA has been very interested in that, and I know Brian and some other folks at MBA have been working on some ideas about how RESPA should be reformed. I really don't think that that's the major concern for most IMBs or brokerages. We understand how to deal with RESPA Section 8. People are mindful about that. I think maybe being a little bit less sensitive to some of the things which were really de minimis exemptions that we respected before would be a good idea, as opposed to looking at anything. If you give a $5 gift card, that's a thing of value, and suddenly you're in hot water for that. That's not helpful. On the yellow comp front, I know the folks at the Bureau who wrote the yellow comp rule very well. Some of them are very close friends of mine. And I think the one thing I would say, with all due respect to them, is that the yellow comp rule was excessively complex. And I think that rethinking that rule is possible without having to worry about steering issues. I think you could do it and make it into something that is a lot less troublesome for MLOs to deal with and for their employers to deal with.
Yeah. All right, Melissa, what are your thoughts?
I don't have anything new to add on the RESPA reform. So I'll talk about LO Comp though a little bit, because we actually spent a lot of time talking to the CFPB about this, and it just was not on Director Choper's agenda. Our push for a long time was lenders should be allowed to lower compensation, especially when it benefits the consumer. And right now it's not possible. And that's a piece that I think would be like low hanging fruit, super easy, as long as it benefits the consumer. LOs should be able to lower their compensation. So that's something we were pushing on for quite some time. But as Al said, there's just lots of layers of complexity to it that I think could also get cleaned up and help all of us as a result.
Latasha, you're the general counsel for a top 15 mortgage lender with over 500 originators, $7 billion lender. And this is something you've talked about a lot. So would you like to see it fixed? Would you like to see adjustments? Is it not broken?
I like to see it fixed, and I've been talking about this since the rule went into place. Similar to Al, in private practice, I worked with some of the writers of LO compensation as well and understood the intent. And at this point, we have a multitude of data on what worked well, what hasn't worked well, what had to be tweaked. We went through the same thing with TRID. We had TRID that came along. There were multiple adjustments that had to be made. We went back to the Bureau with data, with experience, and they made adjustments that made a little bit more sense in terms of administration of the rule. So my biggest thing is bond loans, and I talk about this ad nauseum, and the fact that, I think there should be some common sense carve out if there is a bond loan provided to a consumer, because at least at NFM, over 50% of our consumers are first-time home buyers, and they are using these bond loan programs. And we don't want anything like compensation to disincentivize a loan originator from offering these products to the consumer, because that hurts. And then with regard to RESPA, I said it in someone's comments, like it needs a facelift for sure. The de minimis, $5 Starbucks card, and all of a sudden you're out of compliance with the rule is silly. And so in any other business relationship, you can certainly do things with your referral partner that makes sense to generate more business together. And so, with RESPA, I think there needs to be a fresh set of eyes on that as well.
I'm going to try something different here. Okay. All right. In our maiden voyage here, our maiden panel voyage on one-on-one, I'm going to bring up a topic and just let the four of you talk about it. Is that cool? I'm going to start with, see how this works. Melissa, you post often now. I'm loving what you're doing on social media, on LinkedIn. And I saw a post of yours about AI and AI adoption. And obviously we're in a really interesting time in our business, very exciting with AI use cases. I want you to start off by just talking about your feelings around AI and what kind of impact it'll make. And then I just want the four of you to have a discussion about it.
So AI is, as y'all know, like a really broad topic, and it's been around, I think, since the 50s. in some sort of shape or form. And so it's kind of a buzzword right now because a lot of folks are leaning into more machine learning platforms, the ability for folks to create this kind of predictive analysis for the organizations. And then the use cases really around generative AI for our industry, I think are, for me, the most exciting. The ability to start leveraging AI for decisioning at various parts of our process, I think can help us to think bigger and broader around what's really possible. Most of our loan origination systems, as y'all know, they're built to facilitate this kind of antiquated paper pushing process, right? And so when you think about what's possible around new technology solutions, including AI and generative AI solutions, it allows us to think through things in perspective to data and instead of perspective of paper. And so that's exciting for me. I think the cost of origination for our industry, I think we're $12,000, $13,000, somewhere around in there to originate a loan. And these type of solutions can help us to lower that cost of origination. So that's what's exciting to me. I post about it a lot because I do think there's a lot of use cases behind it. But there are also a ton of questions. And one of them being, how in the world are we going to be regulated on this, right? And so that's just kind of bridge between our last conversation and this one. I mean, most lenders are holding back because they don't understand how they're going to be held liable if they're going to allow for a technology solution to make a decision on their behalf. What happens if that generative AI solution hallucinates and now they're subject to a fair lending concern, right? And so there's things like that I think lenders need help with understanding. But I think it's really exciting for our industry, and the use cases are just endless.
I agree with that.
The one thing I'll say, Melissa, is that if companies aren't looking at the use of AI, not just in production, but on the operational and the administrative level, they are missing the mark. Like at NFM, I oversee multiple departments, vendor management, legal, litigation, et cetera. And we are using this technology. We were talking before we joined the call about investor agreements and warehouse line agreements and using technology to skim some of those agreements, at least as a start, gives you a better lens into what adjustments need to be made to the language. And so all lenders, I think, should be thinking about some sort of option, not just for loan production, because we see the potential there, but they should be looking at where can they use it in human resources potentially, where can they use it legal, where can they use it in vendor management as well.
I agree with that. I would add too that kind of to the point you're making about cost to close. If you look at the top players in the marketplace, their cost to close is significantly less than that. And the problem is that your aggregate that you're talking about, that's coming from the IMBs in the middle who aren't utilizing AI technology, and they're not using it for the reasons you point out, Melissa. And that's why I think understanding the use cases clearly and knowing how the adoption process is supposed to work, whether that's at the board level, through the compliance process, setting up your controls and your monitoring, understanding what's happening within those systems, you can do that, but you're not going to be competitive with Rocket and the other big players if you're a mid-size IMB, unless you know what technology to employ. And if you're not thinking about adopting AI now, you better get started, because the further away you are from that adoption process, the less competitive you're going to be.
Well, and if you ignore the fact that your teams are using AI every day, you're not addressing that with them, that's a huge, huge risk for your organization.
Correct.
I've seen all sorts of use cases where folks are putting data into systems that are not secure systems just for your organization, and things like that can be really detrimental. So, yeah.
Agree very much.
It's such a new technology. There's not much of a roadmap, right? It's going to, some players like, I think the Rockets and the UWMs are going to continue to grab market share because they have the money to experiment, and it could change a lot of the industry, right? The most efficient players are going to be the ones that may win.
Right. Well, they have the money to put in those proprietary systems, and you have large tech teams, and you can develop the things that you want the way you want them. I would add, kind of to the point you made initially, Melissa, that from an underwriting standpoint, I think you really can't look at these tools as decisioning tools. You can look at them as aids from a decisioning standpoint. There is no framework in existence yet to permit the use of AI from a decisioning perspective, and there are risks associated with it. Although I would argue that once these systems are ready, and I'm not sure we're at prime time yet for them, that you're probably likely to diminish your fair lending issues, because those systems can be trained correctly. You're going to actually probably have greater consistency across those platforms than you are with human beings that are doing it. But a human underwriter still needs to evaluate the output of those systems.
That's right.
I think the best example of that is how technology has updated valuations from an appraisal standpoint, right? And using the technology that we've used as an industry already, and how, even that has removed some bias when you're talking about valuations that might have some fair lending impact as well.
That's right.
Agree.
That's a good point.
Agree.
I think you might have had a mic drop moment in there, Al. A minute ago. I kind of like that. I like that. So the new administration has been making rapid changes. We're going to get political for a minute. I apologize in advance, but it's landing in all kinds of different ways. I'll start out. For me personally, I did a post about this 3 or 4 posts ago, that sometimes you gotta break shit and put it back together. And that's my opinion. Other people are very frightened by what's happening. They know people very personally that have been, told to pack their boxes, and there's a lot of uncertainty. So there's that human element as well. I'm okay with what's going on right now. I know that my feeling is, and then I want to know your feelings, and Mark, we'll start off with you when I'm done. Short term, we're going to have a lot more pain than we otherwise would have had under a different administration. We've got to figure out where everything is. Some things are going to break. They're going to make mistakes that they've got to fix. So I think short term, there's going to be more pain, but longer term, we may end up in a better place. My opinion, Mark, you go ahead, and then you guys just go around the horn.
Okay. The new Treasury Secretary, I think it's Scott Bissett. I don't know if I'm pronouncing his last name right. He wants to bring down interest rates, right? So he's targeting the 10-year. And just the fact that we have an administration that's looking and saying that rates are too high, and that their focus is to bring down rates. We've already seen, at least last week, we had a nice run in rates last week. And, under the previous administration, our business was not thriving. Right. We were, every time the Fed says, certain industries are going to experience some pain, that's our industry, right? We've been experiencing the pain. So it's nice to have somebody out there saying rates need to come down and we need to do more business and put more people in houses.
I agree. I would say that I think this notion that we can sort of drive down long-term rates is a bit fanciful. I actually hate to say it, Greg. I started in the industry in 1995 as an MLO, and within about a month of the time I started, I saw rates go from 7.5% to 9.5%, and man, it took them a long time to come back down from there. Rates go up really fast; they come down very slowly. There has to be the right kind of motivation for them to come down. At some precipitous rate. It's not going to happen based on this. And frankly, if you think about the Bureau as it factors into this sort of political circumstance and what it does to the markets like certainty. They don't like uncertainty. Long-term rates don't come down when things are uncertain, they go up. And the one thing the Bureau has done is give confidence to investors that the paper that we're selling, our mortgage-backed securities, are worth more today than they ever have been, largely because of the fact that we have a strong regulator in place that makes sure that people do what they're supposed to do. When you take away that incentive and you create more uncertainty in the market, that's a negative for long-term mortgage rates, in my view. And I think the more we tamper with that certainty that the Bureau's created, the more risk we create for ourselves as an industry.
I agree. I think uncertainty, as you said, Al, is a huge challenge for our industry as a whole. I also think some of that, though, is stemmed by it's very clear that the current administration would love to focus in on improving housing, lowering interest rates for everybody, but some of their policies and some of the things that they're putting together, like a 25% tariff on steel and aluminum, are directly contrary to their what they're saying is their end result. And so I do think there is some uncertainty that is just brought from, we're saying one thing and yet we're seeing, actions in another direction. I do also, I like the foundation of this, and I don't want to get, too political either, so y'all forgive me, but like, I like the Department of Governmental Efficiency, the like foundation behind that, the idea that we can create some efficiencies within all of our government regulations. But I am still a little uncertain around all of the impact of that. I think we've, oh gosh, I'm going to get political for y'all. And not.
It's okay. You're saying it with y'all. So like y'all kind of soften whatever you're
Oh,
doing.
it softens it.
That's right. That's right. That's right.
I'll Southern tie all of it.
Yes.
No, I think there is a need for some efficiencies to be created, but I am a little bit uncertain about how that's going to happen and the impact that's going to have on our industry.
Latasha, you live not far from Washington, D.C. You have a lot of friends in government.
I do.
But you're also helping to run a mortgage company. So where do you land on all this chaos going on?
I think if we look historically at other administrations, Reagan, Bush, Biden, Obama, they all put some sort of organization in place to explore whatever their objectives were and whatever the voters requested. And so, the thing of this, I think that is a distinction is the breakneck pace of how all these parts are moving. But I do think that there needs to be a fresh set of eyes on what we're spending as a government. It's just, how do we do it? That's where opinions differ. And so I think with anything, there's a wait and see approach. And certainly, social media is a driver in a lot of opinions and a lot of anxiety. I have friends at the CFPB and at a lot of these impacted agencies that are getting a lot of these communications. And so it's going to take some patience and also not making any decisions on what we see today, because there's still a lot to do congressionally. There's still a lot to do in terms of lawsuits that have been filed. But, one thing I know about this industry is that we're agile. And so just making sure that we're paying attention, but also not making any rash decisions on what we see today, I think is the best thing we can do. And also be kind. Honestly, we're all humans and all being impacted by this differently. And so being kind to the person who might not be experiencing it at the level you're experiencing it is important right now too.
I just feel like, and I'm bursting out with energy right now, I just feel like the previous administration didn't give any help to the mortgage business. During the Obama administration after 2008, we were given the first-time homebuyer credit, right? $10,000 credit for buying a house, and it was a boost. I saw my pipeline that was falling and falling and falling, and then all of a sudden it just went up with the first-time homebuyer credit. And during the Biden administration, Tesla, all the electric cars got a $12,000 credit, and as rates were rising for us, we weren't given anything. There was no sort of tax incentive to buy a house, and I find, at least with my pipeline, I have almost zero first-time home buyers. They can't afford to buy in our market, and there's no tax incentive. There's no incentive. So when I hear things like rates should go down, I'm at least thinking that somebody out there is thinking about our industry.
I've had a couple of conversations recently. I don't mean to name drop, but I talked to Tim Bowler, who's the president of ICE Mortgage Technology, and also Mark Calabria, former FHFA commissioner. I talked to both of them last week, and they are pitching Capitol Hill, both of them, without knowing the other one is doing it, on ideas for moving people off of their 3% and 4% rates. So some kind of incentive from the government to maybe subsidize and bring the 7% down to 5%, or offer additional tax credits. They both feel like there's a there. So I'm encouraged by that we've got these minds that are thinking about ways that the government can intervene without rates having to come down, right? So that is, does anyone want to comment on that or saying like that? Or you want me to move on to the next topic?
I think I'll just say that, the industry, at least loan originators I'm talking to, lower rates would be great. Stable rates would be better. So if you have customers that are shopping for a home and they're not locked in, and rates are, the 10-year is at 4, amazing. Everybody's perhaps going to lock in. Some are going to pocket float. But then the next day, if 10 years at 4.5, and the impact that has on rates. So for me, yes, we'd love to see lower rates, but we'd also love to see rates be consistent for at least 90, days for us to get
Yeah.
a stable pipeline of customers.
I think that qualifies as our second mic drop, Latasha.
Yep.
Lower rate, stable rates would be better. I like that.
I like that too. Stable rates would be great. September was kind of heartbreaking, right? I mean, we had waited for years for the Fed to start moving on interest rates, and then the anticipation, right? You saw the 10-year dropping. We saw rates in the high 5s, sort of mid-September, and then it was like a rug pull. All of a sudden, it changed course and went the opposite direction. And I think Melissa mentioned that some of the tariffs and some of this talk, sort of it brought uncertainty into the market. And the market does what it does during uncertainty, it goes up. And so that's kind of where we find ourselves right now, not really knowing the impact of all of these new decisions.
I'm going to ask you a question that's probably going to be a layup for Al, since he's a compliance guy. There's a lot of trepidation out there that without a beefed up CFPB, that the bad actors are going to come back, that we're going to start to see more fraudulent loans. Going to play looser and faster. What is your opinion? And I would love one from everyone on the panel.
If you're talking about fraud from within the industry, if you're talking about misconduct, I think there's a great incentive for that. I think the market's still struggling, right? I mean, to Mark's point. And when the market struggles, if you're inclined to take advantage of the absence of a regulator, you're going to do it. Now, I would tell you, that's probably not a bright decision, because if you're state licensed and if you're originating loans, you are, then at least in the IMB space or broker space, then those state actors are going to be much more problematic for you. And I do think that, well, I believe that, and Latasha said this very well earlier on, that having the Bureau set the tone and having a tone that is reasonable for people is the right thing. The state actors will become extraordinarily aggressive, and the cascade effect from license revocation and enforcement actions is incredibly destructive for a lender. You can't, from a reputational standpoint, endure it. So if you really, really get hung out to dry by Massachusetts or New York or California, you may not come back from that. So I do think the incentive is there. I think for people that are not very thoughtful, they may engage in more fraud. But my gosh, if the states catch you, it's going to be a bad day.
Jump in. Come on. Let's go. Who's next?
I completely agree. I think, from a sales perspective, we want to push and bring in as much business as possible without losing our license. But obviously, we don't want to do anything to cause a bunch of buybacks or do anything that would push us out of business. I was working with a lender. I won't mention their name, but they had something like a 40% default rate on one of their products. So they changed the product. Right? It was one of their P&L products. P&L is a profit and loss loan where, you get a CPA to give you a letter that says you made X amount, and then you fund the loan. Well, this lender changed it so that you have to have the CPA letter plus 3 months bank statements. Obviously, you want to see more if you're, if you're having a huge default rate. I sort of think that at the end of the day polices our market. We want to have successful loans so that we don't have any buybacks, so we can all keep making money.
And by the way, when you do have buybacks, you got to report that to the states as well, because they're going to ask you when they come in for the examination. How many buybacks did you have? What kind of investor issues have you had? What are your warehouse banks saying to you? So all of those things factor into how your compliance system is operating.
Absolutely.
All right. Here's a question you weren't prepared for. We can go around the horn on this. I'm not going to let anyone not chip in here. So Latasha, you were very quiet there. I'll let you go first. I'm going to put you on the spot because you're one of the most intelligent, verbose people I know. So you should be able to get this right off the top of your head.
Al triggered me with the states he called out. So I kind of went to a bad, dark place when he called out.
Sorry, Natasha. Sorry.
PTSD. some state PTSD.
Yes.
Oh man,
all
we
right.
have that.
What's the biggest miss in our industry right now? Like, what keeps you up at night? What let me rephrase it. What keeps you up at night? Forget the biggest miss. So what worries you about the industry that you all have been in for so long? We have between me and the four of you, we have over 100 years of mortgage experience on this phone call. How crazy is that? Like, we've been through it all. So I want to know what worries you about the health of our industry, Latasha?
The next generation, whether it's the next generation of homeowners, the next generation of sales professionals, just the next generation of the industry. You mentioned that I wrote a children's book, and I did. But part of what drove me is talking to individuals in their early 20s and 30s about home ownership, and about the fact that they just don't think it's plausible. So they're not even exploring it. They're not preparing for it from a credit perspective or a down payment perspective. And so that is what keeps me up at night, because, like you said, we've all been in this for decades. We're kind of looking at the light at the end of the tunnel in terms of sunsetting in our careers. At least I am. And so, what do you do as a leader and wanting to pass it to the next generation? So, like, that is, what does this look like for the next generation? How do we best prepare this next generation for this industry?
Melissa, I'm dying to hear your thoughts, because as the leader of the Mortgage Collaborative, you were exposed to as many leaders as anyone, and you heard the concerns, and you saw what was going on in the tech space and all these other things. So I'm really curious to know your thoughts on this. What keeps you up at night? What's your biggest concern in the business?
What keeps me up at night and my biggest concern are kind of two opposite ends of the spectrum. And mostly because what keeps me up at night is like the excitement around what's possible right now. I think, so I'll take a little bit of a different spin on it than Latasha did. But I think our industry is at this really cool precipice from a technology perspective. We've cycled through, companies are starting to innovate. We've cycled through finding solutions, but they've been kind of siloed solutions thus far. So we've been kind of piecing together some solutions for our industry, but as we know, that's kind of added to our cost of origination as a whole. I think this next wave, to Latasha's point, that next generation of mortgage professional will have a very different landscape of how they leverage technology, how they communicate with our customers, whether that be referral partners or consumers. I think all of that is changing, and that's kind of really exciting for us right now. On the opposite end of it, it also creates a ton of questions for people on, are they leveraging technology the right way? What are the risks associated with it? Do they understand the new technology enough to be able to speak to a regulator about how they're controlling consumer data and how they're controlling the risk associated with producing a mortgage loan in a different way? So I don't think that's what you meant by it, but that's how I took it.
Great. You go any way you want to go, but there's a lot of bloat in our tech stacks, right? And there are these minimum seat fees, and you've got to sign up for 100 seats, even though you're only using 60. So that's got to get fixed somehow. Yeah. There's a lot of improvement to make. I'd personally love to see consolidation in the mortgage tech space. I feel like a lot of people poured a lot of money in and made big bets that didn't come through, and a lot of them are sucking wind. But there's synergies out there, and I wish I could see some of these companies come together. And maybe we will if rates stay a little bit higher. Mark, you're up, buddy. You've had enough time to think about what keeps you up at night as the owner of a company.
A lot of things, but I'm really afraid that the Fed is going to be late to the game. I think they were late to the game on inflation, and they're going to be late to the game to start lowering interest rates. And we're playing with a small pool here. I mean, you have something like 75% of the population with mortgage rates below 5%. So the people that we're refinancing now, the people that are purchasing now at the 6 to 7%, they're going to be really sensitive to any kind of depreciation. So if the rates stay high and demand dries up, you can see it in the home. Have you guys seen the home builders numbers? They're scary. Yeah. People aren't buying these new homes. So and home builders compete with existing houses. So if people stop buying and the prices start coming down, it can be a cascading effect. So all those people that bought in the last 2 years who really don't have any equity, who want to get into the equity game, they're not going to have anywhere to fall. And so, by the time the Fed reads this correctly and lowers rates to stimulate demand, it could have already dropped more than we'd like it to drop.
Biggest fear is being late to the game, and that they've been late to a couple of games, right?
All of them.
So I mean, I often wake up in the middle of the night and hear Chairman Powell saying inflation is transitory, and that cost us 1.2 billion or trillion. That last tranche of money really hurt the economy.
Yeah.
Al, bring up the caboose on this one.
It's, well, you made a post recently about Fannie and Freddie, Greg, which I really liked. And the thing that keeps me up at night, frankly, is the notion that the most amazing housing finance system in the world could be turned on its head in a way that would be destructive to it. And, I understand your point about breaking things and putting them back together, and I'm not here to debate that with you, but I do think that when it comes to our system, it's the envy of the world. It has created more wealth in this country than we can possibly fathom. It gives people the opportunity to send their kids to college, to have lives that they could never imagine. It's generational wealth, right? If you take apart that system and try and privatize it or whatever people want to do with it, and that system breaks, the amount of damage it does, not just to folks that want to get into the market, but to people that sell them refrigerators for their house and people that come in and paint those houses. And all of the parts of the economy that depend on housing are damaged by that. So I don't want to see the housing system broken by people who are eager to change the way we do things. That's the concern that I have.
Well, it's scary too, because it's not like we're cruising. It'd be one thing if we had a margin of error, but right now it's suck and win. I mean, we just came off of 8 consecutive quarters of losses in our industry. So now, as we're sort of everyone's right-sided, right, and people are cruising, no one's printing money, but at least we know what we know. So if you stack on top of that, getting these two entities out of conservatorship, and they just had their press release on Friday. Would they make $16 or $17 billion?
Yeah, I think that's right. Yeah.
Or like it's not broken right now. So I'm in favor of them taking them out. They were never supposed to be in forever, but is now the time. That's the question. As I look at this unbelievable panel, and I love this, and I got to be honest, during this conversation, I've had this thought in my head. What if the 5 of us got together more frequently or every week, or whoever could make it? Like, this could be unbelievable. So that is something going through my head. But as I look at this, I've been in NFM now the second time around, 16 years, Latasha 15. Al, you've been associated with JB Nutter now for almost 20. Mark, you've had your own company for 10 years or more?
10 years.
Right?
Yep.
Yeah. So there's one person that I've not mentioned who just started a new endeavor. And, kudos to Melissa, formerly the president of the Mortgage Collaborative, and you recently founded the Praxis Lending Solution. So I want to give you a shout out for stepping out. It's so admirable, and give you a minute PSA on what you're up to.
Oh, that's very kind of you. Yeah, you prefaced all those like tenured teams, and then I'm coming in at like 3 weeks and 2 days. So very, very different. Obviously been in the industry forever. So Praxis is focused in on a couple of areas, all really around innovation and technology. So helping boards to understand the risks, the rewards, defining ROIs for technology solutions like AI, machine learning, computer vision, OCR, doing workflow redesign and tech stack analysis, as you talked about, kind of the tech blue, Greg. And then last, doing some fractional CIO, COO, and CXO work for companies. So excited about this, what's ahead.
So you're essentially a free agent. I mean, you're not tied to any one company, right? So if an IMB is hearing this and they want to call and talk to you about possibilities, are there any limitations to that scope for you at this time?
I'd love to talk to anybody. I could always add value to you.
All right. Any closing remarks for anybody here? Anybody want to get something off their mind before we wrap it up?
Well, I know Greg and Latasha, you guys are in the DC area, right?
Yeah.
Yeah. I just want to say, as much as I want to see rates improve and I want to see the whole system blown up, I don't want anyone. My heart goes out to anyone that's losing their job. I don't. No one ever wants to see that. And it's bad for our business too, right? If someone doesn't have a job, they can't, get a mortgage. So obviously, we don't want to see any of that happen.
Or pay their
Same.
mortgage.
Or pay their
Yeah.
existing mortgage. Yeah, good point.
So there's that too. Yeah.
Yeah.
Thank you for that, Mark.
Yeah, absolutely. I couldn't agree more.
Anybody else want to say anything? Or are we all good?
As good as we can get, Greg.
I mean,
Stay tuned.
I'm blown away by how this went, and by the amount of acumen and intelligence and care. And I know everybody on this video right now cares deeply about our business, and we will be the shepherds of the future. So keep speaking up, keep chiming in. You know, Al, I wouldn't have known about you. Nothing personal. You're fabulous. But I wouldn't have known about you if you weren't stepping out on LinkedIn and being courageous and having a voice and giving opinions. Mark, same thing with you.
Sure.
Latasha, I work with every day, and she's one of my very dear friends. So she helps complete me. And Melissa, I know you through the conference scene, which I'm sure I'll continue to see you. But let's at least make sure we do this again here in the near future. If you
All
guys
right.
Love that.
Sounds
Thanks
great.
for having us on, Greg. Appreciate
Yeah,
it.
thank you, Greg.
really appreciate your time. Next Monday on One-on-One, we're going back to the one-on-one format. I will be interviewing a chief economist for Zillow. So you'll have to tune in at 1 p.m. Eastern. You know, I love this guy, and I follow him, and I tell everyone to follow him, but pronouncing his name is a challenge. So Melissa's shaking her head. She may know Orphe Divounguy.
Yeah.
Pretty good, right?
Yeah, it's pretty good.
He's been on CNBC. He's very well known and so thoughtful. And he'll be with me next Monday at 1 o'clock. Have a great week, everybody. Till then.
All right.
Thanks, guys.
Take care.